If you're in the market for a personal loan, one thing you'll notice is the availability of several types of personal loans. In your quest for a personal loan, you will come across personal loans with diverse eligibility requirements, loan fees, and interest types. Understanding the different types of personal loans at your disposal and what they offer can help you choose the right personal loan. Let's start with unsecured personal loans. Most personal loans are unsecured loans. When we say that they are unsecured, the loan isn't backed by collateral. The plus side of unsecured personal loans is that they are a good option if you don't have any assets and typically have lower interest rates than credit cards. Second up are secured personal loans. Unlike unsecured loans, a secured loan needs collateral, like your home or vehicle, to secure or take out the loan. So, if you default on the loan, the lender may seize the asset you put up as your collateral. Fixed-rate personal loans are another option. Fixed interest means that the rate is locked in over the life of your personal loan. As the interest rate will not change, it makes budgeting a whole lot easier. This is common with installment loans like student loans, car loans, and most personal loans. You may want to consider adjustable rate personal loans. With an adjustable rate or variable rate personal loan, the interest rate can change at any time during the term. As the interest rate fluctuates, the repayments of this type of loan will go up or down. Adjustable rate loans can be a good option because they have lower rates and fees compared to fixed interest personal loans. And if interest rates decrease, your repayments will be less. Some downsides include the increase in difficulty to budget, as repayments vary according to the changing rates. And when interest rates rise, so do your payments. Debt consolidation loans may be a good option for you, depending on your situation. This type of personal loan rolls multiple debts into a single new loan. Combining all your debts into one personal loan allows you to save on interest repayments and easily make payments. Co-signed personal loans are for borrowers with poor or no credit history who may not qualify for a loan independently. The co-signer acts as a surety and promises to pay the loan if the borrower defaults on the loan repayment. Adding a co-signer who has a strong credit and financial history can improve your chances of getting approved for a personal loan. This can be a great option because it's easy to qualify for due to the high creditworthiness of the co-signer being attached, which means you can usually receive a lower interest rate too, although this means both you and your co-signer are responsible for the loan. If you default on the loan, both your credit and that of the co-signer will receive a negative hit. So, choose your financial partners carefully. You can also consider a personal line of credit, more like a credit card than a personal loan. Rather than getting a lump sum of cash, you get access to a credit line from which you can borrow on an as-needed basis. A few things to consider are that with such easy access to money from a line of credit, you may get into serious financial trouble if you don't control your spending. And if interest rates increase, you may have difficulty paying back your line of credit. Another option is payday loans, which are short-term unsecured loans, usually up to $500 to cover expenses until your next payday. We do not encourage you to take out payday loans due to their exorbitant interest rates, which can be anywhere from 13 to 26 times the interest rates typically found on credit cards. Please do not use payday loans. A pawnshop loan is a secured personal loan. You borrow against an asset, such as jewelry or electronics, which you leave with the pawnshop. If you don't repay the loan, the pawnshop can sell your asset. Rates for pawnshop loans are very high and can run over 200%. Like payday loans, you should never get a pawnshop loan. Credit builder loans are another option. They are easy to apply for and designed to help you rebuild your credit or help you build credit for the first time. Your credit score improves as you make timely payments, opening you to other financial opportunities and savings. It is important to note that these loans are not free. You will have to pay interest and various fees. Wedding loans, like vacation loans, are generally unsecured and meant for a specific purpose. Weddings can be expensive, and coming up with the cash for one can be challenging. A loan can help smooth the way, especially if you have good credit and get a low interest rate. Vacation loans are generally unsecured. You can get one of these loans to go on a trip and see new places. However, the downside is that now you might spend several months or even years repaying it. Medical loans are unsecured personal loans that cover healthcare costs. They can be used to consolidate existing medical debt, cover emergency or planned medical procedures like dental work or plastic surgery, or pay for high deductibles and out-of-network charges. A personal loan can help you get the money you need for different purposes. However, anytime you borrow money, you need to be careful. Only borrow what you need and try to pay off the debt as quickly as possible to reduce what you'll pay in interest. If you like this video, then make sure you hit the like button, subscribe, and join us every week as we break down personal finance topics in plain English.